You're listening to BitTalk, a podcast about Bitcoin, money, freedom, and the ideas that matter. If you're getting value from the show, like, follow, and subscribe. It helps more people find this content and helps spread Bitcoin. I'm Mike, here for the signal, not the spin.
Hey, I'm Lauren. Welcome to BitTalk. Let's jump in.
So here's the tension we're looking at today. We've seen the biggest institutional Bitcoin ETF inflows since October 2025, over $1.5 billion since early March. But it raises an awkward question. What are you really holding when you buy one of these products? And how does that compare to the actual keys in your hand thing?
It's not about which is morally superior. It's about operational trade-offs. And most people don't realize the choices they're making when they click buy on an ETF versus setting up a hardware wallet.
Right. It's like choosing between a landlord and owning the house outright. Both have plumbing risks, but the liability lives in different places. One guy you can call at 3 a.m. if the pipe bursts. The other, you better know how to use a wrench.
And the landlord might decide to sell the building. Let's get into it.
Bitcoin Veterans is building a community where service, purpose, and Bitcoin come together. Through education, events, podcasts, and meetups, they help veterans connect, learn, and find a new mission in the Bitcoin space. Learn more at bitcoinveterans.org.
All right, let's start with the mechanism. Lauren, what exactly is a spot Bitcoin ETF doing that a futures ETF or a self-custodied wallet isn't?
Big question. And it's the foundation for everything else. A spot Bitcoin ETF, like the ones approved last year, holds actual Bitcoin in custody. The fund buys real coins, puts them in a vault, and registers them to the fund. You, as the shareholder, don't have the private keys, but the SEC and a regulated custodian are watching that stash.
Okay, so the Bitcoin is there, physically, digitally, whatever.
Exactly. Now compare that to a futures ETF. That fund doesn't hold Bitcoin at all. It holds contracts that promise to deliver Bitcoin at a future date. Those contracts expire, get rolled over, and that rolling process introduces tracking error and costs. You're essentially owning a derivative of a derivative.
So if I buy a spot ETF, I'm exposed to Bitcoin's price, but not to Bitcoin's network. Is that right?
That's the cleanest way to put it. You get the price movement, but not the permissionlessness. You can't send that Bitcoin to someone in another country at 2 a.m. without needing a broker to process the redemption. You can't verify transactions on your own node. You can't use it in a Lightning payment.
So it's Bitcoin exposure with training wheels, and also with a gatekeeper.
That's actually a great analogy. The training wheels are the regulatory framework and the custodian's insurance. But the gatekeeper is that same entity. If they decide to freeze redemptions, or if the SEC changes the rules, you're stuck.
And on the self-custody side, you skip all that, but you're the one responsible for not losing your seed phrase.
Right. And that's not trivial. The Bitcoin community loves to say, not your keys, not your coins. But they don't always add the fine print. Your keys, your full responsibility.
Let's dig into those institutional inflows. Because $1.5 billion since March, that's not pocket change. What does that actually tell us?
It tells us that big allocators, pension funds, endowments, family offices, are treating Bitcoin as a long-term store of value. They're not day trading. The on-chain data backs this up. We're seeing reduced exchange inflows alongside the ETF buying. That means holders aren't selling into this demand. Coins are moving off exchanges into cold storage or ETF custody.
So it's like a cargo ship loading steel, not a day trader flipping tokens. This is committed capital.
Exactly. But let's pressure test that. Inflows don't predict price. They signal that sophisticated money sees Bitcoin as an asset worth holding for years, not weeks. They're accepting the ETF wrapper because it fits their compliance and custody requirements.
It reminds me of the early days when people would say, I bought Bitcoin on PayPal. That wasn't Bitcoin. That was an IOU. An ETF is a more sophisticated IOU, but still an IOU. The question is whether you're okay with that.
And for institutions, the answer is usually yes, because they have fiduciary duties and audit requirements. They can't have a hardware wallet in a sock drawer.
So the operational takeaway here: ETF flows are a gauge of institutional risk appetite, not a directional signal for price. Use them as context, not as a trading trigger.
Right. Now let's talk about the core trade-off. Because there's a real tension between intermediary risk and technical discipline.
Walk me through that.
Imagine you're a busy professional with a demanding job, a family, and no interest in managing hardware wallets or worrying about inheritance planning. An ETF is a reasonable tool. You pay a small fee, you get exposure, and BlackRock or Fidelity handles the security.
But you're trusting them.
And that's the catch. You are trusting them to not get hacked, to not go rogue, and to not be legally compelled to freeze assets. Custodians have been hacked before. Regulators have frozen assets before. It's not paranoia, it's historical precedent.
And on the other side, if you self-custody, you have to deal with firmware updates, seed phrase backups, and the very real possibility that you make a mistake and lose everything.
Exactly. The worst nightmare for an ETF holder is that BlackRock gets compromised. The worst nightmare for a self-custody holder is that they drop their hardware wallet in a lake and didn't back up the seed.
So neither is objectively correct. It depends on your operational ability.
Here's a practical heuristic for listeners. Ask yourself, can you secure a $10 bill for 10 years without losing it? If the answer is yes, you can probably self-custody. If you've ever lost your phone or forgotten a critical password, an ETF might actually be the less risky option for you.
That's honest. I like that.
Bitcoin Veterans is a group of military veterans, and Bitcoin advocates focused on education, community, and helping veterans build purpose and resilience through Bitcoin. From podcasts and meetups to resources and events, they're creating a place for veterans to keep learning and keep growing. Visit bitcoinveterans.org to learn more.
And we're back. Lauren, I want to talk about something I think catches a lot of people off guard: covered call Bitcoin ETFs.
Oh, this is important. Some Bitcoin ETFs, like the Goldman Sachs Premium Income ETF, employ what's called an options overwrite strategy. They sell call options on Bitcoin or Bitcoin-related assets to generate income.
Translate that.
When you sell a call option, you're selling someone else the right to buy your Bitcoin at a fixed price, the strike price, by a certain date. In exchange, you collect a premium. That premium becomes the yield the ETF pays out.
So the ETF makes money from selling these options, but at what cost?
The cost is that you cap your upside. If Bitcoin moons past the strike price, the ETF has to sell its Bitcoin at that lower price. You participate in none of the gain above that level. But if Bitcoin dumps, you still have full downside exposure. There's no protection.
So someone buys a Bitcoin ETF thinking they're getting pure exposure, but they've actually sold their upside without knowing it? That feels like a hidden trade.
It absolutely is. And the yield looks attractive, say 8% or 10% annually. But you're trading away future appreciation for that income. In a bull market, that's a terrible deal.
So always read the prospectus. Not all Bitcoin ETFs are created equal.
Couldn't agree more. If you want passive Bitcoin exposure, avoid options-based ETFs. If you want income and you're willing to cap gains, fine, but understand exactly what you're selling.
Let's zoom out to the big picture. Fixed supply, halving mechanics, on-chain behavior. How do these structural facts connect to what we're seeing with ETFs?
Over 20 million Bitcoin have been mined. Fewer than 1 million remain to be issued over the next century. Halving events every 4 years cut the new supply in half. That's not a trading signal. It's a structural fact.
But institutions seem to be acting on that fact.
Exactly. They're buying ahead of the next halving, not reacting to it. The on-chain data shows coins moving off exchanges into cold storage or ETFs. That's a deliberate shift from trading to holding. It's the kind of behavior you see when people expect an asset to become more scarce.
I remember when HODL was a joke on a forum. Now it's literally how the biggest money in the world operates. The narrative has matured.
It has, and that's the key. Fixed supply and halving are structural facts that inform long-term strategy, not short-term timing. They're already priced into institutional behavior.
Let's wrap this up with some actionable takeaways for listeners. Lauren, give me the decision framework.
Okay, number 1, know what you own. If you're buying a Bitcoin ETF, find out if it's a spot ETF or a futures ETF. Spot holds actual Bitcoin. Futures holds contracts. They behave differently.
Number 2,
Self-custody versus ETF. Assess your risk tolerance and technical ability. If you can manage keys and backup securely, self-custody gives you total control. If you can't, an ETF with a reputable custodian is a reasonable alternative.
and watch out for options-based ETFs.
Absolutely. If you see covered call or premium income in the name, read the prospectus. You are trading away upside for yield, and most people don't realize they've made that trade.
Finally, use ETF inflows as a signal of institutional appetite, not a price target. They tell you what big money is doing, not what the market will do next.
The most important thing is to know what you own. Understand that if you buy a spot ETF, you have a claim on Bitcoin held by a custodian. That's not the same as Bitcoin in your wallet. Both are valid, just different.
And if you ever try to explain this to a friend, just say renting versus owning. Both have a place, but you should know which you're doing.
That's the episode. Let's wrap it up.
Thanks, Lauren. We hope this gives you a clearer operational lens for evaluating ETF versus self-custody.
If you've got a specific setup question, drop it in the comments. We read them.
Thanks for spending time with us on BitTalk. If this was useful, follow the show, leave a like, and subscribe. It helps more people find us and help spread Bitcoin. Until next time, keep learning, keep questioning, and keep stacking knowledge.